Welcome to The Explainer. Today, we're unpacking Onsemi's explosive Q1 2026 stock jump, their radical corporate transformation, and exactly why Wall Street is literally racing to hike their price targets. We're going to look at the hard data behind their massive margin expansion and the aggressive capital moves management is making right now.
Let's jump right in with an absolutely massive number, $6 billion. That's the share repurchase authorization Onsemi just announced. They're kicking off this giant program on January 1st, 2026, which pretty much proves they're betting heavily on their own future. When a company signals they're willing to spend basically 100% of their free cash flow on themselves, well, you gotta ask, what exactly do they see that the rest of the market is just waking up to?
Here's our roadmap for decoding all of this. We're hitting the semiconductor phoenix rises, the fab right transformation, Q1 2026 earnings breakdown, Wall Street's target hikes, the $6 billion buyback, and finally, risks in the circuit.
Let's kick things off with Section 1, the semiconductor phoenix rises, from boom and bust to high margin.
You see, the old ON was a high-volume manufacturer of discrete, logic, and analog devices. They were constantly playing the victim to the boom and bust cycles of the commodity chip market and honestly struggling to even hit 30% margins. But the new Onsemi totally changed the game. They ditched $2 billion of that low-margin business to focus laser-like on intelligent power and sensing. And now, their non-GAAP gross margins are consistently landing between 38 and 45%. It's a huge shift.
Which brings us to Section 2, the fab right transformation, pruning to grow. This whole turnaround was driven by CEO Hassani El-Khoury's Fab Right strategy, which rolled out back in 2020. They basically changed the company's DNA. They divested those smaller, inefficient fabs and made a really visionary move in 2021 by snapping up GT Advanced Technologies. That specific move let them own the entire silicon carbide manufacturing process, literally from growing the crystal bowls all the way to final packaging. Fast forward to 2025, and they've successfully transitioned to 200mm or 8-inch silicon carbide wafer production. That is a massive milestone that drastically cuts the unit cost of their power modules. As part of this overhaul, they cleanly restructured the business into 3 really focused pillars. First, you've got the Power Solutions Group. Think of them as the muscles, managing power flow in EV inverters and renewable energy grids. Then there's the Analog and Mixed Signal Group, the brain, providing the gate drivers and controllers that dictate exactly how that power moves. And finally, the Intelligent Sensing Group acts as the eyes, pretty much dominating the market in automotive image sensors for advanced driver assistance systems. All right, moving into Section 3, Q1 2026 earnings breakdown, the numbers behind the narrative. So how did this look on the balance sheet? Well, Onsemi just beat Wall Street's expectations completely across the board. They posted $1.51 billion in revenue, topping the estimated $1.49 billion. Adjusted EPS came in at 64 cents, beating the 62-cent estimate. On top of that, they actually guided Q2 revenue above the street's expectations, giving a really strong signal that demand indicators are finally improving.
And anchoring this all in reality, their corporate filings show a super solid free cash flow generation of $217.2 million for the quarter. You know, in an industry that absolutely demands massive capital expenditures, generating this kind of cash flow, even during a cyclical dip, is exactly what gives them the firepower to aggressively buy back stock and push R&D, all without stretching their balance sheet.
This momentum naturally leads us to Section 4, Wall Street's target hikes, the hype phase. Following those numbers, both Roth Capital and KeyBank aggressively hiked their price targets on the stock up to $125. The narrative out there is shifting so fast. Analysts are pointing to massive wins in AI data centers, which, by the way, require incredibly intense, highly efficient power delivery and liquid cooling, plus a recovering automotive sector and stronger seasonality expected in the back half of the year.
The broader sentiment has flipped hard. We've got multiple firms circling this bullish narrative right now, with Deutsche Bank specifically calling this quarter a true inflection point for the company. Look, when you see this many top-tier houses moving their targets from the 70s and 80s way up into the $115 to $125 band, it tells you institutional belief in Onsemi structural improvements has completely solidified.
Next up, Section 5, the $6 billion buyback, putting money where the moat is.
To back up that hype, management announced a staggering new $6 billion share repurchase program over the next 3 years. And remember, they have a proven track record here, having already bought back $2.1 billion of stock. Using capital this way is a complex tool,
but it essentially protects existing shareholders while signaling absolute massive internal confidence in their future cash flow generation. But we have to look at the whole picture. Section 6. Risks in the circuit. The reality check. Let's be real for a second. Over 50% of their revenue is still tightly bound to the highly cyclical automotive sector. So despite this brilliant corporate pivot, they are inherently vulnerable to any prolonged EV slump or stubbornly high interest rates that choke auto loan financing. If cars aren't moving off the lots, Onsemi's main growth engine starts to sputter. Plus, active traders are flagging a very rich valuation right now. With a praise-to-earnings ratio that has actually stretched north of 300 during these momentum spikes, the stock is basically assuming flawless execution. When a stock is priced for perfection like that, there is practically zero room for error. Markets can and will punish weak earnings violently. If their AI integration or that big 200mm manufacturing scale-up hits any snags at all, the drop could be pretty swift. And there's definitely some tension beneath the surface of this latest earnings beat. Despite the great revenue numbers, inventory days outstanding actually crept up from 191 days to 200 days. This is your classic lagging indicator of the recent auto sector slowdown, and it definitely signals a need for caution. It tells us that, yeah, they are shipping product, but inventory is still stacking up a bit in the background. Lastly, there's the location factor. They've heavily concentrated their silicon carbide manufacturing in Bucheon, South Korea. Now, while this scale-up promises an amazing 80% increase in die yield per wafer, placing such a critical physical asset in a geopolitically sensitive region adds an undeniable layer of risk to an otherwise brilliant vertical integration strategy. So, as we watch the electrification of everything unfold and power-hungry AI data centers join the EV revolution in demanding smarter, more efficient power, I want to leave you with this question. Has Onsemi truly transcended its boom and bust past to become the guaranteed architect of our electrified future? Or is all this massive Wall Street hype just masking lingering cyclical vulnerabilities before the next big pullback? Think about that as you digest the numbers we've covered today. Thanks for tuning in to The Explainer.